Walk into almost any luxury boutique, whether they sell Italian sports cars or high-end designer coats, and you will eventually find a mechanism to clear out unsold inventory, a quiet markdown, an end-of-season sale, or a private client discount. It is the basic law of retail economics. Supply adjusts to meet demand. Then there is Rolex, a brand that categorically refuses to participate in this cycle. You will never see a clearance tag on a Submariner, and you will never receive a promotional discount code from an authorized dealer. This creates a glaring economic contradiction. If a buyer walks into a store with thousands of dollars in cash, standard logic dictates the business should take their money. But this company regularly turns away willing customers. This refusal to discount or accommodate immediate demand is not a temporary marketing tactic. It is a structural paradox that supports a multi-billion-dollar empire. To understand how they engineered this system, we have to look at how the brand was built. In 1905, the watchmaking industry was anchored in tradition, and London was a booming center of commerce. This is where 24-year-old Hans Wilsdorf, a German entrepreneur, entered the business. At the time, gentlemen carried pocket watches, heavy, intricate instruments tucked safely inside waistcoats. Wristwatches existed, but society viewed them with open contempt. They were considered feminine accessories, fragile, and incapable of keeping accurate time. Wilsdorf observed a culture that was rapidly accelerating. As trains, automobiles, and industrial machinery redefined daily life, he realized professionals could not afford to fumble in their pockets for the time. They needed it accessible on their wrists. Because traditional watchmakers dismissed his idea, Wilsdorf partnered with a Swiss movement manufacturer to source small, precise calibers. By 1908, he gave this operation a short, symmetrical name, Rolex. To dismantle the stigma against wristwatches, Wilsdorf knew he could not simply market them differently. He had to prove they were scientifically reliable through an obsessive pursuit of mechanical accuracy. That effort culminated in 1914. After 45 days of rigorous testing, in 5 different positions and 3 extreme temperatures, the Kew Observatory in Great Britain awarded a small Rolex wristwatch a Class A precision certificate. Before that moment, this level of certification was almost exclusively awarded to massive marine chronometers, the heavy boxed navigation instruments used to calculate a ship's longitude at sea. By achieving an average daily rate of only +1 second, Rolex proved a small format watch could rival the best measuring instruments in the world. This certification provided the scientific legitimacy Wilsdorf needed, making the wristwatch a viable tool for navigation and industry. Rolex spent the following decades cementing this reputation through specific engineering leaps. In 1926, they developed the Oyster, a hermetically sealed case that protected the delicate movement from dust and moisture. 5 years later, they eliminated the need for daily manual winding by inventing the perpetual rotor, a self-winding mechanism driven entirely by the movement of the wearer's wrist. These engineering leaps made Rolex a standard requirement for deep-sea divers and early aviators operating in open cockpits. As commercial aviation opened up the globe, pilots navigating multiple time zones on transatlantic flights relied on models like the GMT Master to track their routes. By the modern era, this toolmaker has reached a level of market control that defies its origins. The specialized instrument maker now operates at a commercial scale that dwarfs its closest rivals. Observational. This chart of estimated annual production volumes illustrates the sheer scale of the company today. Recent industry reports show Rolex produces between 1.15 and 1.24 million watches every single year. That massive volume translates to total financial dominance. Generating roughly 11 billion Swiss francs in annual sales, they capture a full 33% of the entire Swiss luxury watch market. They produce more units and generate more revenue than their top 4 competitors combined. The dedicated toolmaker has scaled into the world's most profitable luxury watchmaker. Yet, if you walk into an authorized Rolex dealership today, that massive 1.15 million annual production volume is completely invisible. Instead, you will find pristine display cases that are entirely empty, save for a few pieces labeled exhibition only. There is literally no inventory available for you to purchase. If you want a highly desired model, like a steel Daytona or a GMT Master 2, you are placed on an opaque waitlist. Customers regularly wait years for the mere privilege of receiving a call from their dealer. A buyer can walk into a boutique holding $14,000, the average retail price of a Rolex, and be flatly rejected by the sales staff. Rolex has created an environment of artificial scarcity. In their showrooms, traditional buying power is completely useless. You cannot simply buy your way to the front of the line. This total refusal to accommodate immediate retail demand has an immediate economic consequence. It fuels an explosive secondary market. Look at this line graph of watch valuations. While retail price remains a flat, controlled line, desperate customers drive a spiking secondary market. This creates a massive premium gap. A $10,000 retail watch might instantly trade for $30,000. This is where standard economic theory falls apart. Any basic business textbook states that a company facing massive, unmet demand should aggressively expand factory production to capture more sales, or raise retail prices to absorb that extra profit. Rolex does absolutely none of this. They maintain strict control over retail pricing, and they limit dealer allocations, and they refuse to flood the market with millions of extra watches just to satisfy a temporary frenzy. How a global corporation maintains dominance by ignoring the standard rules of growth is the central question. Rolex is controlled by the Hans Wilsdorf Foundation, a private trust. This structure removes the influence of public shareholders. There are no quarterly profit targets, earnings calls, or external dividend expectations, forcing the company to maximize short-term cash flow. This financial independence allows for a level of vertical integration that is rare in modern manufacturing. Rolex produces nearly every component in-house. They forge their own proprietary metals, manufacture movements, and analyze microscopic components with their own internal laboratory standards. While public companies are often pressured by Wall Street to offshore production or accelerate volume to boost profit margins, Rolex's mandate is different. Management uses their independence to cap production based on internal quality thresholds. They do not increase supply to meet temporary market spikes if it risks compromising those standards. This immunity to external financial pressure allows them to manage physical inventory with total, uncompromising discipline. That discipline extends from the factory floor to the point of sale. Notably, Rolex does not sell watches directly to consumers. They distribute through an authorized dealer network. These third-party retailers must sign contracts that dictate exactly how the brand is presented and sold. The core of the agreement is simple. If a dealer offers an unauthorized discount to close a sale, they risk having their authorized status revoked. For a jewelry store, losing the Rolex agency is often a terminal blow. The foot traffic generated by the brand is frequently what supports the rest of their business. Discounting tells the consumer that the original price was a fiction. By banning it, Rolex ensures that the retail price remains a stable benchmark of the product's value. This leads to the strategy of artificial scarcity. Rolex would rather let boutique shelves sit empty than flood the market and force their dealers to lower prices to move stock. This policing transforms empty store shelves into a signal of exclusivity. The lack of available product becomes a testament to the brand's desirability. When production control meets rigid retail pricing, it changes the buyer's internal math. Functionally, a modern smartphone provides a more accurate time for free, yet collectors gladly endure years on a waiting list to pay full price for a mechanical alternative. This chart compares the value trajectory of a standard luxury good, which drops immediately after purchase, against the stable value retention of a Rolex. Because the manufacturer prevents price erosion at retail, consumers begin to view the purchase as an entry into an asset class. Buyers are willing to pay the full sticker price for a GMT Master 2 because they trust the manufacturer will never devalue their purchase with a future sale or a clearance event. Success in this market is not built on the engineering of the watch alone, but on the guarantee that the price paid today is protected by the company's corporate structure for decades to come. Those empty shelves are not the result of a broken supply chain or a manufacturing bottleneck. They are the physical evidence of a perfectly executed, highly controlled strategy of intentional scarcity. By strictly controlling primary availability and refusing to budge on retail prices, a natural economic pressure valve formed, a massive, highly lucrative secondary resale market. Because demand drastically outpaces the supply at authorized dealers, buyers turn to the pre-owned market. Highly sought-after models, like the Daytona, routinely trade secondhand for double or even triple their original retail sticker price. For decades, that secondhand premium went to independent dealers. But in 2023, the brand acquired Bucherer, the world's largest luxury watch retailer, pictured here at their Lucerne location. Alongside this corporate acquisition, they launched their own certified pre-owned program. They brought the resale market under their own umbrella. Authorized dealers can now buy back used watches, authenticate them, and sell them at the higher market value, allowing the manufacturer to capture the profits generated by their own scarcity. The math making this possible relies on an economic concept known as Veblen dynamics. In a normal market, raising prices lowers demand. For a Veblen good, the desirability actually increases as the price goes up. This line graph illustrates a Veblen demand curve, sloping upward as price increases. The high price floor creates exclusivity, but standard retail strategies use discounts to clear inventory. This artificially spikes short-term sales, but immediately erodes that premium baseline. Every time a brand puts a product on clearance, it signals to the consumer that the item was originally overpriced and is losing intrinsic value. By maintaining absolute price integrity, a luxury purchase stops feeling like a disposable expense. Models with enduring designs, like the Submariner, become reliable stores of value, a liquid asset or an inflation hedge you can wear on your wrist. A strict zero discount policy is a psychological guarantee to the buyer that their capital is safe. If withholding discounts and starving the primary market is so lucrative, why don't rival luxury brands simply do the same thing? The first hurdle is legal. Under antitrust laws in major jurisdictions like the European Union, manufacturers are explicitly prohibited from fixing retail prices or forcing independent distributors to maintain minimum prices. To navigate selective distribution agreements, contracts limiting exactly who can sell the product, the manufacturer relies on indirect pressure. Retailers technically have the freedom to set prices, but if a dealer independently chooses to offer an unauthorized discount, they face the extreme threat of losing their authorized dealer status, a penalty that can instantly bankrupt a showroom. Enforcing that kind of ruthless discipline is nearly impossible for publicly traded luxury conglomerates like LVMH. Public companies, including those under the Richemont umbrella, are bound to Wall Street shareholders. They must hit quarterly growth targets, which inevitably drives them to discount unsold inventory to generate cash flow during economic downturns. This reveals the structural shield protecting Rolex. The company is entirely owned by a private charitable trust, the Hans Wilsdorf Foundation. Because they don't answer to a stock market, they are completely insulated from shareholder pressures and dividend demands. True pricing power requires an operational structure that allows management to prioritize a 20-year brand horizon over a 3-month earnings cycle. The physical mechanics of these watches are flawless, but the true product being manufactured at the bench is the careful, deliberate engineering of permanent financial value. The entire system acts as a self-reinforcing flywheel. Strict price controls in the primary market create premiums in the secondary market, and those high resale values fuel an insatiable demand for new models at retail. Operating this machine requires immense corporate discipline. The company must be willing to let shelves sit empty and turn away immediate cash today, so they don't have to chase volume tomorrow. It proves that industry dominance is not achieved by chasing a closed, uncompromising ecosystem where the customers chase you. To see how other global brands engineer their market dominance, subscribe to the channel. Let us know in the comments which corporate strategy we should break down next.